This is how many adults live in the US. This is how many of them have a health savings account. And this is how many people who have a health savings account aren't maximizing it the way that I'm going to show you in this video. It's what's going to turn this $669 medical expense of mine into over $4,400 of profit. Let me show you what everyone misses about an HSA and how you can turn it into a money printing machine. Don't worry, I'll show you how much money I have in my HSA after contributing to it over the past 5 years. I'll have warnings all throughout this video trying to talk you out of an HSA because it's just not for everyone. So if you miss any of those warnings or any other part of this video and you make a mistake, then you can't say that I didn't warn you. This especially goes for people who live in New Jersey and California. I'll cover it later in detail, but just a heads up that your states have chosen not to give you full access to the benefits of an HSA. At a basic level, an HSA is a savings account that's attached to a health insurance plan where you can contribute pre-tax dollars and spend those dollars on medical expenses. Most of you are probably thinking,
hold on, stop the video. Did this weirdo just say that you can only spend the money on medical expenses? Psh, no thanks. I don't like that kind of restriction on my money, so I'm gonna pass.
Wait a second there, judgmental Jerry. I haven't even gotten to the part where I explain how to supercharge an HSA. I do need to stop the video for a second to call out that an HSA is completely different from an FSA. The easiest way to tell the difference? With an FSA, you have to spend the money within a short period of time. It's essentially use it or lose it since you can't roll it over into future years. With an HSA, there's no time limit as to when you have to spend the money. So money in the account will roll over and over and over every year until you use it. Way too many people get the two mixed up and tell me about it in the comments section of my videos. My fingers are starting to hurt trying to correct everyone. There's also a few other restrictions as well, which I'll put on screen right now because we need to start getting into the part of the video where I show you how to turn this thing into a money printing machine. To be able to contribute to an HSA, you must be enrolled in a high deductible health plan. Later in the video, I'll show you how to make sure you're picking the correct health plan to be able to contribute to an HSA, but just know that this is the first rule that you have to follow. The nice thing about being enrolled in an HDHP with lower premiums is that you can use the extra money you would normally pay towards the higher premiums for a traditional health insurance plan and put that money into a health savings account. Starting in 2024, an individual can contribute up to $4,150 and families can contribute up to $8,300. For all of my friends who are 55 and older, you can contribute an additional $1,000 per year as a catch-up contribution. Two things I need to mention about yearly HSA contributions. First, you don't have to contribute up to the maximum. While I encourage people to try, it is not an all or nothing type deal. So it's okay if you cannot afford it. If you're an individual and you only want to put, say, $2,000 or $3,000 of the $4,150 into the account, then that's fine because it is still beneficial. Second, some employers will contribute money on your behalf as a part of your compensation, like your salary, vacation days, 401k match, and things like that. If they do, then this will reduce the amount that you're able to contribute by that amount. For example, a company that I worked for in the past offered to contribute something like $800 if we did a personal health screening. When that was completed, they would deposit the $800 into my HSA, which meant that I could personally contribute up to the difference for that year. Before I get to this stuff later in the video, I want to show you how to supercharge a health savings account, which is what most people don't know about. Based on recent research, 93% of people with a health savings account look at the account as a way to save up for medical expenses in the near term, hence the name health savings account. These individuals deposit money into the account every month and pay for those expenses as they come up. There is nothing wrong with using the money in this way at all. If that's what works for you, then please keep doing it. But if you want to join myself and 7% of people who have an HSA, then this is how you supercharge the account. Instead of treating an HSA like a health savings account, I want you to treat it like a health investment account or health retirement account. Think of it like another retirement account such as a 401k, 403b, 457, or IRA, but with a little bit of a twist. One of the reasons it's better than all other retirement accounts is because of the triple tax savings, but I don't want to get ahead of myself, so we will cover that in just a minute. Thinking of an HSA as a health investment account has two benefits. First, it's kind of like an additional health insurance policy where you get to keep 100% of the money. Second, it's a way for you to start pre-saving for medical expenses that you're 100% going to have in the later years of life. None of us make it out of here alive, and those medical bills pile up very quickly when we're older. According to Fidelity, the average 65-year-old retiring this year is estimated to spend around $157,000 on healthcare and medical expenses for the rest of their life. If you're married, then you can double that amount. For those of us who aren't retiring for another 10 plus years, we can expect that amount to only increase because of how broken the healthcare system is in the United States. In retirement, you're going to have to pull from one of your retirement accounts to pay for medical expenses. So instead of pulling that money from something like a 401k or IRA, you can instead pull from an HSA that's optimized for that specific purpose, then use the money in all other accounts for your other expenses. When you put money into an HSA, there's three things that you can do with it. Number one, as I mentioned before, you can use it for medical expenses that come up in the near term. Number two, you can deposit the money and let it just sit there. Now, some HSA providers pay you interest on the money, but it would basically be like holding cash in a checking account where they pay you a horribly low 0.02%, so your money essentially gets eaten away by inflation. Or number three, if you want to supercharge your HSA, then you can deposit money, then choose to either invest some or all of the money. Since your goal with the supercharged method would be to avoid touching it so that it could grow, you would pay for your medical expenses out of pocket. Because I had a $669 medical expense for contacts, I paid for it out of pocket so that I didn't have to touch $669 that's invested within my HSA. This way, I have the opportunity to allow that money to more than 7x into over $5,000 30 years down the line. While I technically paid $669 out of pocket, I'm going to get that $669 reimbursed to me, plus the over $4,400 investment growth because the money had time to compound. Over the past 5 years, I've paid $3,300 out of pocket for various medical expenses. But instead of thinking of it as an expense, I think of it as an investment that will be worth over $25,000 in 30 years. I'll spend that over $21,000 of growth on either other medical expenses or non-medical expenses, but more about how you can spend HSA money on non-medical expenses later in the video. Let's compare two people who both have an HSA but treat it differently so that you can fully understand the different paths that you could potentially go down. Seneca the Spender and Ivan the Investor both max out their HSAs for 30 years starting in 2024. Since families can contribute $8,300 per year, just double the numbers I go over. Keep in mind that over 30 years, the contribution limits will increase due to inflation, but to simplify things, let's just assume that it doesn't change. Seneca spends all of the money on medical expenses over that time, so he's left with $0 in the account. Ivan leaves that money invested and pays for his $124,500 medical expenses out of pocket. At a 7% average annual return, his account is worth a little over $391,000. You might be scratching your head, questioning how realistic it is that you'll ever spend $391,000 on medical expenses. Once again, hang tight because later in the video, I'll show you how to use HSA money for non-medical expenses. To make things fair, because we're assuming that Ivan the Investor has an extra $124,500 lying around to pay for medical expenses out of pocket, we have to assume that Seneca the Spender also has $124,500 lying around as well. Both already max out their other retirement accounts, so Seneca decides to invest that money into a taxable brokerage account, which grows his money to the same $391,000 as Ivan. On the surface, it seems like they're both ending up with the same result, but they're not. Seneca the Spender is still coming out behind, and here's why. First, we're assuming that Seneca is disciplined and has his financial behaviors under control enough to be able to invest $345 per month into a taxable brokerage account for 360 months straight. If he misses contributing for even just 1 month, then his account is already behind compared to Ivan. I'm not saying I don't believe in Seneca. Heck, he is my favorite Stoic philosopher after all, but he has two very powerful things going against him: human nature, and life. There's enough behavioral research out there to prove that the odds are against most people if they have an extra $345 laying around every month. It's easier than you think, and most of us like to admit, to just spend a little here and spend a little there as opposed to investing it. If you think about it, most student loan borrowers showed us what humans do with extra money in their pocket when payments are paused for just a few years. They spend the money. The second reason Seneca the Spender won't actually have the same $391,000 as Ivan the Investor is because of taxes. Since Seneca is putting money into a taxable brokerage account, he's going to have to pay taxes on the yearly dividend distributions from his ETFs or index funds. On top of that, when he goes to sell his investments to withdraw the money in 30 years, he's going to have to pay long-term capital gains taxes. If his account is worth that $391,000, and he lives in a state like Ohio, then he'll pay over $54,000 in taxes to the federal and state government. With an HSA, you get a triple tax savings. No other retirement out there offers this level of savings, which is why it's better than every single one. First, unlike a Roth 401k and IRA, you contribute money to a health savings account with pre-tax dollars, which in turn lowers your modified adjusted gross income. I'm no CPA, but lowering your modified adjusted gross income to save on taxes is usually a good thing. Second, you don't pay taxes on the growth of money within your HSA. So if you receive dividends from your ETFs or index funds, then it won't be taxed. If you sell any of your ETFs or index funds for a gain, then you don't pay taxes either. Third, unlike a traditional 401k and traditional IRA, you're not taxed on money that's withdrawn from the account for approved medical expenses. Here's a warning for anyone living in New Jersey or California. Your states don't recognize the federal tax advantage treatment of an HSA, so your contributions will be after tax for state and income purposes. Growth within the account is also taxable at a state level as well. Before I show you how to open a health savings account, we need to go through how to make sure that you're picking the correct health insurance plan to be able to contribute to an HSA. I get a lot of questions about this one, so please pay attention. But first, if you want to help support my little rescue dog Molly as well as this channel, then please hit that thumbs up button and share the video. Or you could consider supporting us through that super thanks button down below. As I mentioned before, to be able to open and contribute to a health savings account, you have to be enrolled in a high deductible health plan during the point in time when you contribute to an HSA. If you aren't enrolled in an HDHP, then you cannot contribute to an HSA. There's no ifs, ands, or buts about this rule. You have to be enrolled in a high deductible health plan. Here's your second warning. It should be obvious, but I'm going to say it anyways. High deductible health plans don't make sense for everyone. You're going to have to weigh the options based on your specific situation. Going into this in more detail goes way beyond the scope of this video, but I can tell you that high deductible does not always equal bad. Something else that should be obvious is the fact that keeping up on your physical, nutritional, and mental health not only helps you live a longer, happier life, but it can also reduce your overall medical expenses if you're on a high deductible health plan. Later in the video, I'll share a free toolkit on HSA and health-related resources that have helped me in this area over the past 15 years. Back to making sure that you're picking the correct health plan. Here's the benefits page for one of my previous employers. As you can see, they mention that this is a high deductible health plan. If you get health insurance on your own through the healthcare.gov website, then you can filter on HSA eligible plans, and they specifically call it out for each plan. Not all employers will call out if a plan is an HDHP or HSA eligible. So check with your HR department just to confirm. That way you don't accidentally pick the wrong health insurance plan and think that you can contribute to an HSA, but you really can't. Also, not all employers will offer a high deductible health plan, which means that you cannot enroll in one, which means that you cannot contribute to an HSA. If this is the case for you, then it might be worth it to reach out to your HR department to see if they're willing to offer an HDHP. Now, they might not be able to offer it this year, but they may be able to offer it next year. Once you are enrolled in an HDHP, you're going to need to open a health savings account with an HSA provider. An HSA provider is the third-party company that's in charge of housing and managing the funds that come into your HSA. HSA. They're essentially an IRS-approved custodian. Some of the more well-known providers are Fidelity, HSA Bank, Health Equity, HSA Authority, and a few more. If you are enrolled in a high-deductible health plan through your employer and they offer an HSA, then they have already chosen who the provider will be. For example, one of my previous employers had chosen to work with Health Equity, so that's who I was forced to use. Your employer should give you the details needed to open an account with their chosen provider. Every time you get paid, they'll take your pre-taxed HSA contribution from your paycheck, then deposit it into your HSA account where you can choose to either let it sit there or invest it. If your employer offers an HDHP, but they haven't chosen an HSA provider, or you get health insurance on your own, then you're going to have to open an account with any provider that you want. Then deposit money into your account. For people who find themselves in this position, you're really going to need to be on top of depositing money into your HSA on a regular basis to get the full benefits. It's easy for these things to slip our mind when we have to do it manually. So I highly recommend setting up some sort of auto deposit so that way you never miss a contribution. At this point in time, my preferred HSA provider is Fidelity. Specifically, their self-directed Fidelity HSA because they don't charge any fees. I do not prefer the Fidelity HSA Go managed account because they do charge a fee. They offer all of the Vanguard ETFs that I prefer and allow you to invest 100% of your money. With some HSA providers, they force you to keep a certain amount of money uninvested, which is extremely annoying, and one of the main reasons that I stopped working with Health Equity and Lively. Something I found out recently is that not all HSA providers allow you to invest any money. Now, I can't recall which ones they are off the top of my head, so just make sure that you do your own research if that is a feature that you want. One thing to note if you have to go this self-directed, self-funded route is that you'll be contributing to your HSA with dollars that have already been taxed by your employer. When you go to file taxes for that year, you should receive a form from your HSA provider to let the IRS know that you contributed X amount of dollars to an HSA. This will lower your adjusted gross income by that contribution amount so you get the tax advantage. The only disadvantage of having to go the self-directed route is that you won't get the tax adjustment for supplemental security income or Medicare like you would if an employer was depositing money into the account on your behalf. Because your HSA is held by a third-party provider, you can take it with you anywhere. So if you leave your current employer and you're not happy with the fees or investment options, then you can transfer it to a new one. For example, when I left my previous employer, I wasn't happy with some of the fees Health Equity charged, so I moved my money to a Lively HSA. When Lively started charging certain fees, I wasn't happy about it, so I moved it to a Fidelity HSA where there are 0 fees. The process is extremely easy to do. Just make sure to do a trustee-to-trustee transfer so that your old provider sends the money directly to your new provider. Oh yeah, and you initiate the transfer process with the provider where the money is going to. So your new provider. If you're planning on paying for your current medical expenses out of pocket so that you can leave the money invested, then you're going to need to keep track of your receipts. Think of these medical receipts like literal dollar bills because it's important that you keep them since you're going to eventually cash them in at some point in the future. You want to have a paper trail so that in say 30 years when you go to withdraw the money for an expense that you had today, there's proof that it was a legit medical expense. If the IRS decides to audit you and you didn't withdraw money for an actual medical expense, then good luck to you. You can't say that I didn't warn you. No freaking way should you rely on keeping paper receipts to track everything either. I prefer to create a digital system which is a foolproof way to keep track of everything and keep it in order. The IRS is extremely clear about keeping track and making sure that you can prove the medical expenses that you had in the past are for actual medical expenses. In that free HSA toolkit resource, I'll show you how I personally track all of my medical expenses. I'll explain later in the video how to get a hold of that. Warning time, some HSA providers tell you that they will keep track of your receipts and expenses, but that is not acceptable. If you happen to switch to another provider because they make changes that you don't agree with, then good luck trying to get a hold of those receipts they were tracking for you. It might feel convenient in the moment, but it's going to be a pain in the butt later down the line if you switch to somebody else, just like I did when I got rid of Health Equity and I got rid of Lively. You need to track these things on your own, period. Some people rightfully question the reality of being able to reimburse yourself way into the future. Is the IRS really going to let you do this? Let's go back to the IRS's IRS's website to get the facts straight from the source. There you go, there's the proof. But what if you happen to live an extremely healthy life to where you don't end up spending very much on medical expenses? Well, let's play a fun game of what if. Say you contribute to and invest in an HSA for the next 30 years. The account has grown to, we'll say, $300,000. But because Americans are just so well known for being the healthiest, most active people in the world who also take the least amount of prescription drugs, you're not going to spend any of that HSA money on medical expenses. Congratulations, you hit the lottery. Well, the good news is that contributing to an HSA hasn't been a complete waste for all those health nuts, because starting at the age of 65, you can actually withdraw HSA money for non-medical expenses. Yes, there's a catch. There's always a catch. The catch is that the amount you withdraw will be taxed as ordinary income. So it essentially turns into a retirement account like a traditional 401k and traditional IRA. The big difference is that with a traditional 401k and IRA, you're going to have to take required minimum distributions starting at age 72. With an HSA, there's no RMDs. Pretty cool, huh? Am I the only weirdo that thinks this is amazing? Just another reason to add to the list for why an HSA is better than any other retirement account. I repeat, do not use HSA money on non-medical expenses before the age of 65. If you do, then you are basically canceling out the benefits of this account. That's because the amount you spend will be included in your income to be taxed and is subject to an additional 20% tax. I wouldn't suggest trying to slip one by the IRS either. Assume that they are going to catch you. I've mentioned before how I used to work with an idiot who went to Walgreens to buy his prescription meds. Now, when he checked out, he threw in a few candy bars and paid for it with HSA money, assuming that they wouldn't notice a $1.50 candy bar here and a $1.50 candy bar there. Not only was he giving himself diabetes by eating that candy bar, diabetes, but he was also given a 20% tax by the IRS because they caught him. I like the guy, but I call him an idiot now, and I called him an idiot then because he knew what he was doing was wrong and did it anyways. I don't have sympathy for those kind of people. Now for how much I have in my HSA. I started contributing to it at the beginning of 2019, so roughly 5 years at the end of this year. My balance is currently sitting at a little over $18,000 with a few more contributions left for this year. Over the past 5 years, I've had an average annual return of a little under 7%, which is on target with what I always plan for. The 2022 market decline is what dropped this average return way down. But as a long-term investor, this wasn't a surprise to me at all, since years like that are extremely normal. During the first couple of years, I was invested in a Vanguard S&P 500 index fund, since that was the best option that I had available to me within my employer-sponsored HSA. I personally prefer total US stock exposure if possible, so since I've moved everything over to a self-directed HSA, I hold 100% in the Vanguard Total US Stock ETF, VTI. I do subscribe to the two-fund portfolio method right now, so my international index funds and ETFs are held in accounts that are outside of my HSA. One more big warning for you. If you can't commit to investing for at least 7 years, then be extremely careful before investing your HSA money. In my opinion, the stock market is way too volatile in the short term to be messing around with this strategy if you cannot afford it. The last thing you want is for your portfolio to be down 20+% when you need to withdraw money for medical expenses. If you made it this far in the video, then congratulations, I appreciate it, and I have a little bonus for you since you stuck around. I am oddly obsessed with educating people on HSAs because I think they are extremely powerful. I have a lot more HSA info and helpful tips that I'm going to put into a free HSA resource. I'll have a link to get a copy down in the description below. Please hit that thumbs up button before you go and share the video with someone that you think it could help. I'll see you in the next one, friends. Done.